Good evening.
Good evening.
You know we got to do that again. Good evening.
Good evening.
How many people here are first time to hear Eric make his mid-year presentation? Wow, that's awesome. So from you old timers, what does Eric always do for us that he doesn't do for any of his other people? He does not dance. What does he do?
Puts grass up there, explains it.
He does the charts and graphs and all that kind of stuff. But in addition, Mark, you're on the right track. What does he do? Explains it in our language. And then he does his famous predictions and projections, right? So, but then he does his famous emojis, right? Smiley faces, frowny faces, even faces. So for you newcomers, if you're having problems with the technical part, just add up all of Eric's happy faces and subtract out all of his frowny faces, and you'll have pretty much a good idea of where he thinks the economy is going. It's all about smiley faces. So, Eric, let's see how many smiley faces we have tonight. All right, sir.
Thank you, everyone. Please. You come my annual pilgrimage to Memphis. I love it here. The dancing is extra. Larry. So, as Larry mentioned, we're going to discuss the markets. And we'll tackle material in a very simple way, right? What's the easiest way to go first? Bite-sized chunks, right? So what we're going to do is we're going to start with where we've been. Essentially, all that is a rehash of what we talked about either at last half times, where I do a kickoff as well in February. It's not cherry picking, it's most of the exact slides that we actually put up on the board. It's an amalgamation, accumulation of various data points, right? So there's going to be fundamental type analysis data points, technical, behavioral. If there's ever any question on them, it's either a smiley face or a cry face or a check. I mean, it doesn't track what I'm trying to relay in the message of that slide, right? I don't like to spend a lot of time in the weeds. It's not fun for anybody, even great. And then we'll figure out, all right, where did we think the shape of the market was going to look like for the first half of this year, based on our data? And then how did we do? It's kind of like our score product, our victory lap, and it's not fungible, right? You take these every time. The slides are out there as proof. Once we get past that, we're going to take stock of where we are, current. Things you're hearing on TV. I'm going to try and distill and figure out what of all this noise, what these data points that we have in front of us today, that we really need to consider as we kind of craft the mosaic of where we think the market's going to go. All right. Again, we'll figure out some we think are important, some aren't at all. Right. So now that we're going to have this big pool of new information, now we get to the payoff, the last section, right? And that's we take all that data that we just went through and figure out, if you put it all together, what does that tell us, if anything, about what we think the market will do for the next 6 or 12 months? And then what that lets us do is figure out, do we need to do anything to course correct in the portfolio? So we position right, do we make adjustments? So pretty simple. Let's start with where we've been. So 2024. But I'm going to dial it back. The first couple slides are going to go back to cover last year because I wasn't with y'all in February. Rehash though. So we have this thing in the markets called rosy retrospection, where people just forget about all the things they said and the mistakes they made. Coming into 2024, most of the strategists were very negative on margins. They really couldn't see their way to more than a couple of % gain, if at all, in the marketplace. we were obviously of the differing opinion. I'm not going to go exhaustively into it, just a couple of slides. But essentially, all the data that we looked at, again, fundamental, textual, when we put it all together, said, we're begrudgingly in the market. We hear all the noise, but the market is telling us something different. And we participated and hopefully get really nice 20 some odd % year. And as strategic strategists, we're pretty far off. Right? And I don't do it to disparage the strategists. This is the hardest job in the world for someone to have to go and make a guess about when the market's going to be here. Nobody knows where it's going to be tomorrow. If they tell you, they do their lives, right? Right. The best we can do is 98, 90%, right? We can get an idea, but to think like, I just try it. Unless, of course, this is the summation, essentially, of McKinley. I didn't walk you through all the slides we put together, but we look to do a lot of cycle composite history. So the blue line was the S&P. The orange line is what we thought the market was going to do, and not to the dollar, the shape. The market we thought was going to end the year much higher than started. That was kind of right. So again, we were on the right side of the markets, 2024. I always find it interesting about the politicians. Look at this. The market did 20 some odd %. Millennium, the most highest performing hedge fund, did like maybe 30. Nancy Pelosi did 54%. There's no politics in this at all. And it's kind of interesting to me how this. You do so well. Tell me if you have sweet information that did not know. Equally funny is the fact that if you did the opposite of what Jim Cramer told you to do, you would have been up 43%. Right. And again, I put these out there, especially kind of for Kramer, not because he's not incredibly intelligent, but the fact is, just because someone is spewing at you on TV doesn't necessarily mean they know what they're talking about, right? When they're put on TV, there's this implicit trust there. Oh, this guy must be an expert. Well, not really. So these are more kind of caveat emptors for you. Don't really pay attention to what you're seeing a lot today. So, where were we then? This is how I was feeling. I don't know, you 20% years back to back. You want more? I don't mean spicy heading into this year, right? What do we make of it? So I started, as I often do, with the strategists. This looks pretty good, right? A lot of the strategists coming into this year were very positive. That makes me nervous, especially when they're all pretty similar in price, right? Maybe they're looking at some of the similar data, right? But I often, in our profession, if too many people are on one side of the boat, typically it ticks over, right? And so at first I was like, I don't love this. From a contrarian perspective, I didn't love this too much. But we do our own research. We don't just take for granted what's given to us. So we dug into the past history, and there's been 9 other times when you've had back-to-back 20% years in the market. What did it do the following year? So now the average is 13. Now that kind of tracks. Wasn't that about what they were saying? They thought the market, they were reading these tea leaves here. But when I look at it, I go, well, okay, there's 2 negative years up there, and there's some big years up there, right? So that's a pretty big change in experience. So, all right, I get it. I can see the idea that the market, and there's some historical precedent to be higher. That's fine. Valuations. We touched on this in February. If you haven't seen it, the kickoff is recorded. We can get it to you via link. But this is what I was worried about at the very beginning of the year. Some stocks were particularly expensive, right? That's all this is. You like to buy cheap stocks and sell the expensive ones, right? So the S&P was getting really expensive, and in particular, it's like 7 stocks. They reference them as the MAG 7. For years, like 493 of the other stocks didn't do much, right? Now, It's masked by the fact that 7 of them carried the market, but that was getting really expensive. First time hits, right? I didn't like that heading into the year. And this dovetails with it. So now, again, not only was the market getting expensive, easy slide, don't worry about it. Just think these bars is the number of stocks participating in the rally. Here's where we were. Last time that happened was 99. Yes. So here we have, again, just a few stocks. I mean, as of today, NVIDIA is 8% of the S&P. One stock, right? I think the top 7 or 10 stocks is 60%, right? So you really don't own a diversified basket like you think if you've got the S&P, right? So might not list stocks. And right now we're down to like the Mag 3 that are still going higher, right? And NVIDIA's earnings are tomorrow, so we could have some shake up there. But to me, that's another, not quite frowny face, but it makes me think, right? I don't love this. Market was moving higher, but not very healthy, right? So this comes up a lot. And you're going to hear it ad nauseum. A lot of different opinions on politics in the market. Politics plays zero role in our investment analysis, right? We are data-driven. We're facts, not feelings, right? And so I've gotten so many questions about it. And we can torture the data. I can tell you what the average return is in a, income in president's second year if he's a Republican born in Dallas, whatever. I mean, they have the data, right? It's not worth anything, but they have it. And so I found this one, and this one is the only one that I need. Let's take it to extremes. The red line is if you only invested only when a Republican was in office. The blue line is Democrat. Black line is just being in the market. Do you see the problem? It doesn't correlate, right? And so to me, it's always just noise. It's posturing, it's rhetoric. If it's actually impactful, we're going to pick it up in some of the supply demand that we see in the market. We'll pick it up, but not from CNBC or Fox News or whatever we're hearing. That's irrelevant. Having said that, we seem to have a market positive president, at least in the things he's trying to do, would seem on paper pro-growth, right? All right, so now we're getting into the behavioral aspect on this slide, fear and greed. And it's often misquoted that, you don't go with the crowd is wrong. The crowd's usually right about 90% of the time. When the crowd is wrong, unfortunately, it's typically at the worst possible times, right? So we're right for the bulk of the move. They get it really wrong at market tops and really wrong at market bottoms, right? So I look for those kind of signs in the market. So if the market's really high and greed is really high, all right, we've got a problem. But if I look at this, wow, the market's really ticking off of highs and we're still fearful because people are still on the sideboard. So to me, that was kind of a positive. Okay. I like that part earlier in the year. Okay, this is an evergreen slide because at any given point in time, we're always in some part of the presidential cycle, right? And what we know from the markets is there's kind of a rhythm that the markets take, and this is just every 4-year cycle blended together. And so we were here. So again, I think this is what the strategists were looking at. So we're hearing everybody, oh yeah, we have mid-year front loaded returns, pull back at the end of the year. Party line, that's what everyone was saying. So I knew for sure that's exactly not how it was going to play out. What I see here is volatility at some point, but a market that ends higher. Okay, so I think that's more useful information, right? Expect volatility. Expect it, though, to have a kind of an upward trend to it. So that helps us when we're positioning, when we see the markets move up, move down, what we want to do. So that was okay to me, right? Now this is where we jump into Veritoria with my research guys, and we get a little geeky, and so we added to the 4-year presidential cycle just a seasonal cycle, just the months of the year, and a 10-year decennial cycle. So we're looking at these cycles that impact the market and mash them up. Again, this was the same one I showed you on slide 2 that for 2024 kind of had us going up and to the right, perfectly tracked with long it's again up and to the right. So should be a positive year, right? That's my takeaway. So now we get to our northern star, right? Sometimes I'm embarrassed to explain like some of the bedrock and foundational things that run our process because it's actually really simple. You all learned it in Econ 101. Irrefutable law of supply and demand. More demand, price goes up, more supply, price goes down. It's irrefutable, right? And so what you're looking at here is a simple visual representation, what takes about 1 million calculations every night. And what we're doing though is we're trying to track the supply and demand within and amongst these asset classes. These are the basic building blocks of your portfolios, right? Fixed income, cash, international equity, U.S. equity buys, right? These are the big. We can peel the onion, we go deeper and all that kind of stuff. But these are the basics, right? This is what you see on your statement. I have equity, I have cash. So, entering February, what do you notice? U.S. equity is still the #1 relative strength asset, our favorite asset class. Commodities and international, 2 and 3, still commodities strengthening a little more. You don't see the scores under like I do. But what this tells us is we had our 3 risk on, called riskier asset classes, in control, right? Where we start to worry is where you get fixed income and cash up here. These were here in 2007 for the meltdown. So oftentimes when I go through this, it's sometimes misconstrued as like a market timing. That's what that doesn't work. This process is like the Titanic turning in a harbor. It's a dimmer switch. These things happen under the surface slowly, right? You're not gonna wake up tomorrow and that's over there. Just, they don't bounce around like that, and that's by design, because we'd be all reason, and that's not what we wanna do. But this setup tells me kind of the all clear. People are interested in risk for what it's worth, right? Again, this is just for what it's worth slide. So where we left in February was, I think the markets have got a little complacent. This was getting, so it's kind of the beginning of the year. So it's a little bit overvalued. You're probably due for a pullback. And I mentioned this because markets take the escalator up and they take the elevator down, right? Like a little guy, Price is Right, falling off a cliff. And I say that because markets go down 3 times faster than they go up. So I can tell you, don't go in the face, stock market's gonna have a correction when it's gonna get volatile. What happens anyway? What happens April 22nd when the market's down 15%? It's a behavioral heuristic. Well, do I need to do something, right? And the point is, at that point, don't be reactive. You do more damage than anything, right? And our process is proactive, right? We saw this risk of what's going to happen in April earlier in the year, so we were already dialed back to risking in portfolios, right? And so I hope you noticed that on the statements, right? I didn't go down as much as the markets. If it has probably gained and much bigger than the average portfolio, right? So we kind of hit it right on the head, right? Like the year, we thought we had some volatility coming, right? So that's the mini victory lap, I guess, right? Great, doesn't matter. That's in the past. What do we do now? So, one of the great wordsmiths of our generation said, everyone has plans, punched in the face, right? And so that's kind of where we are. So all that happened. Did we execute? Did we panic? Right? As you know, we never panic. Everything we do is emotional, unbiased investment process. So I don't know what the rest of the marketplace did, but I know we didn't bang, right? And so let's pull back up that composite, right? So that blue line is that one that we thought would be the shape of the market. Now, we got back here. That was a pretty different route, right? And again, that's why I don't often like to get cute with the analysis. Just front-loaded return. Nobody's that smart. Never. I wouldn't be here anymore. I would have worked for 2 years tomorrow and they could have done nothing, right? Yep. So we didn't quite take the exact path, but we got there. And over the last couple of months, we're right back tracking, right? So we are in August, where we should have been based on this cycle. It's a little bit of a different tack to get there, a little more volatility. But again, not unexpected based on the slides that we saw earlier, right? Things are expensive, we had a couple of stocks, we're due for a pullback. With no stock to pull back, just dragged everything down, right? So the recession that we've been talking about for 5 years, is it coming? I don't know. That's why I don't engage in that discourse, right? And I've said this 4 years. You can have your economist up here and just give you these brilliant explanations of why this is going to happen, this is going to happen. Well, probably theoretically true, but at the end of the day, it doesn't help us, right? Money if thens, if that, if this. So when I'm asked about the recession question, I typically like to just look at a couple of data points that are very consistent over time, right? The first being GDP. All right, this is the growth of our economy. And so, yeah, we had a right print there, the first quarter, bounced back nicely in the second quarter. Now, I think if you look under the hood of this data, there was probably some tariff front running in the first quarter, that showed up in the second. It's just how I account for the trade deficits. So maybe we're at 1.5, 2, but still positive, right? You know, nothing like this. So, you know, I don't know. I mean, things look okay. We get a check mark now, right? Here's the flying the ointment under the hood of possibly. So we were looking at that GDP number. The consumer, us and through, are 70% of GDP. We need to spend, get the money flowing through the economy, right? And so there's 2 bars here for each data point. The yellow bar is AI investment only technology. Blue is consumer spending. And what do you see happen here, 25? One of the first years where the AI spending by probably a dozen companies alone eclipsed what all of us spent. That's a little torture. That's a little challenging, right? That can't go on forever. So it frightens me a little bit, right? Just me being the consumer, right? And we're seeing already buy now, pay later, credit card delinquencies, mortgage delinquencies. Not great, but it's been happening for a long time. So again, I'm not raising the flag here, but something to think about. But what? I mean, I get it. These peach articles here are recessions. Essentially, what this chart is telling you is that unemployment turns up right before recessions. Kind of logical, right? So, not a whole lot of information there, but where are we? We're just bouncing along the bottom. That we turned up. I don't know. Maybe obviously the last few reports haven't been great, but we're at basically full employment. Right? We filled the position at our firm. 800 applicants. All right, so we only ended up taking it. Right? So, I don't know, I feel like we might be bent the economy, but not broken. I think we're okay. Here's what spooked the markets, though. Okay, this is another reason why I as many times as it happens, but I'm shocked by it. So they'll put out the ADP implement, whatever it is. Everyone reacts to that number. And everyone reacts to that number knows that the following one that gets revised, that it gets revised twice. The number you're seeing is essentially meaningless, right? And so what you're seeing here is the actual numbers after the revisions, and this is what kind of spooked the market a couple weeks ago, right? Revisions took the numbers down to basically nil. So again, all right, job creation is slowing a bit. It's not great. We'd like to see it the other way, but not the end of the world, in my opinion. This could be the problem, right? Inflation. That was a problem 4 years ago. So there was this point in time where inflation started heading up in 2, 3, 4, 5, and you all heard the story that it was transitory, right? That it looks that way on its way to 8 or 9%. I don't know, it's the story. We'll tell you why we didn't buy that story. And we have slides in the deck a couple of years ago to back this up. Inflation is caused by one thing only. Too many dollars chasing too few goods. Period. We can have all the other discords and water out of it. Today, that's what drives price supply. In our country, from 2010 2020, right after the great financial crisis, we all remember that one, our money supply doubled. 100% increase. And then COVID went up another 40%. That's its definition. Inflation was coming in a big way, right? So we were ahead of that, just like we felt it was coming down for the last year or two, right? And we see the data. We've leveled off. But the worry is we take our foot off the brake too early, right? There's something that we'll call inflation embargoes still in the economy, right? I remember when you're camping, you put your fire out, fire out, it's clear. So what we're worried about here is the Fed is getting a lot of pressure, raise down, start easing in our economy. As inflation is still at 2%, in like the 70s, some may remember, we started to get inflation under control. We got a little bit laissez-faire about it, and then it came back in a massive way, right? We're ready to go to 20% in interest rates. We're in a good position here. All I have more and more to have. And I think that's why Powell's hesitant to lower rates, because he knows this is the worst of two evils, right? The Fed is dual ending, inflation and employment. They're supposed to work on the one that's more deviating. Oh, we just went through employment, 3.1% inflation versus 2 benchmark. That's pretty deviating. So theoretically, he should be thinking about raising rates, right? I won't do that, but the idea is inflation is seemingly getting under control as long as we don't increase our money supply too much. That's what we're looking. That's what I'm looking out for now. We've been doing some stealthies and gradings, and I will say that if we move interest rates down, or it might we're window dressing, right? It's a different lot of the year. But if we go to 2% or 1%, like we're suggesting, that would be catastrophic. Housing. So housing is one of those interesting things that's like always at a crisis. Either prices are too high or prices are crumbling, right? Never any in between. But again, this was a simple supply and demand exercise. So look back at the great financial crisis. We, as a country, were forming about 10 million households a year. But since the prices were cascading so high, we were building 18 million houses. What's that? Your supply and demand. And why was this happening? I don't know if anyone remember the Ninja loan? No income, no job on the application? Insane, right? People in Florida owning 4 or 5 condos, them jive. What could go wrong? And so it finally caught up, right? The builders were building it. All right, someone's buying it, right? It wasn't them getting hurt. It had to be the banks and the people. But supply over demand, price come down. It's definitional. So where have we been? Obviously, the home builders now got a little bit gun shy. They've remained that way. They've underbuilt for decades. They're still going to get burned again, right? But now all of a sudden, what's happening? Our formations are up 15 million a year. We're only building 13. That's what's, I believe, keeping house prices up, even though some of us may be stuck in a good way. I mean, most people from probably like myself, who you financed or refinanced at like 3% or better. I'm never selling that. Like, can't be never wasting that money in our lifetime, right? But it's the fact is, we should be building more. That's probably what's propping up housing. But then why are so builders now have 10 months of supply of funds. Wow, I mean the last happened 6 other times in history, 5 times led to a recession. It's not great. And so that's why they're not building more, right? There's a disconnect. Those of us who can afford to move aren't moving because we're, I don't want to say stuck again, but if you bought a house in the last 5 or 10 years, right? So it's not like there's no reason to move. And everyone that wants to buy a house is priced out. Either now that the mortgages are so high or the prices are so high. So I'm not sure how dumping more money into the economy is pushing the price up higher. I know. The thinking, though, is that, we lower interest rates and mortgage rates come along. That's incorrect. When the Fed moves that silly rate that they're going to move in a couple of weeks, it literally means nothing. It's a short-term interest rate. Mortgages are based off 10-year and further. So you'll notice that rate will probably go up. Right? There's questions about the fiscal solvency, the credibility and confidence in the dollar. So we're in a pickle here. Right? We need housing price to come down a bit, maybe get some activity. I don't know. But that gets the crying Jordans, right? That's a tough spot to be in. Right? I'm not sure how we get out of that one. So sentiment, let's bring the sentiment back. That was one of the referred nuggets from the beginning of the year, right? Markets were at highs, but people were still pretty fearful. I've got 2 slides and try to slice and dice this data. The first one is, all right, here's these market peaks in pink. Let's call this the sentiment. How positive were we at those peaks? Plus 29. Plus. It's kind of leveled out here. Where are we now? Well, if this turns out to be a peak, we're as bearish as we were after that tariff tantrum, and even more so than housing prices. To me, that's a positive. No matter what they're saying, people seem to have a careful with stuff. If you're careful, I wouldn't be in the market. Maybe they tried 100. I don't know. This one strikes me as positive. Right? The market, they call it climbs the wall of worry. Always does, right? And that's where we are now. This is the most heated rally this year. It's a fact. Even though the strategist said it, most people aren't participating. There's always a reason not. So that's positive. Let's try to get some other understanding. Maybe the way we were calculating that wasn't very helpful. Let's try it again. So we just moved up off the April bottom. Now we're over 30% in the market. So I said, all right, how about the last 4 times that happened? Let's try that out. All right, so back here, we were still positive, negative, or flat, negative. I do see a little bit of a slope. Maybe we're just getting more negative as a society. I don't know. But this is an outlier. I mean, again, look at that. Just as low as. So this makes me positive on the intermediate to long-term prospect of the market. Right? That's a contrarian indicator. So let's put a bow on it. Right? So we've spent some time looking at various data points. Great. What do we think? Right? What do we think this all means when we synthesize it together? we think the shape of the market looks like from here. Markets are like a pendulum. There's only one or two things that you should remember from tonight. This is a very important one. So we've got, let's call it equilibrium, say like 6 o'clock on your clock. That would be like, what's something worth? All these fundamental analysts, oh, this stock is intrinsic value, homeostasis, whatever. What happens in a time like at the beginning of the year, they got expensive, and we're showing you a slide, so they were up here, expensive. Now when they come back, have you ever seen pendulum just stop? Momentum, right? Going. So we're showing. So oversold, and that's what happened in April. Now we've corrected, we came back. I think we're back here again on a short-term basis, right? We've gotten overdone again. And that's kind of how the market it vacillates. It's never where it's supposed to be. It's always a restaurant. That area, right? And so right now, again, I think we're back here on the pendulum. I think the market's able to hang itself on very short-term cases. Let's go back to the cycle. I'm going to have you look at it in a slightly different fashion. Right, so now instead of being here, this year is here. Right, same exact presidential cycle, same exact volatility here. But I want you to focus on this part. Right. A lot of times we make a mistake of being too myopic of the markets, right? And that's because of the flow of information. There was a time where if you wanted a stock quote, you had to look at the paper, especially yesterday. That's when I started in the market. You have to call me for a quote. We had a monopoly on info. You couldn't get it. You couldn't call us. Where's Tucker? I could have made the number, right? Now it's every second you have the data we have. I don't know if that's a good thing, right? Because the short term in the market is measured in quarters and years, not days and weeks, right? So when I say short term, right, we can predict where the market's kind of heading. We never know the time, right? It does it on its own. So what I want you to look at here is we've just entered what I affectionately call the box, right? Every 4 years, I'll break this side out. It's just the same, right? It's great. A lot of my stuff is evergreen. Pretty little effort. And what you'll notice is, and again, we had a correction. I don't think that's the one and only. What I see here is a period of extended volatility where the market just kind of grinds sideways. And what I get from this is I call this the don't be a hero moment, right? There are times to be in bets where there's favorable risk reward. You want to be aggressive in market. Unfavorably, you don't. Very simple, right? I use a driving analogy. Pick a flat place, Arizona at noon. It's straight highway. You're gonna go, right? All right. Well, now you're in somewhere in New England at midnight in a snowstorm. What do? You slow down. That's what our portfolios do. When we see conditions are right, we dial you up. When they are wrong, we dial it back. It's never always done. That never runs. That's silly. We just kind of adjust, right? And so my purpose in this is usually somewhere around now until he made the box a little big. I'll talk to him about that when we get back to the office. I should stop around here, like somewhere in the third quarter of next year, right? It's a period of volatility. I'm going to show you a really busy slide. Don't worry about it. I'm going to circle. There are only two things that matter. But these are all the instances of that box. In that box, we typically get about a 20% correction. So figure on average, again, the numbers are scattershot, but I think 4 years ago, we did the same thing, right? It was about to be 26% on that one. So in my estimation, somewhere in the next, another 2-3 quarters, we're going to get another decent pullback. We need one, all right? And so when I have this type of data in front of me, I immediately go to a more defensive left. All right, so I'm from Tampa. We got lucky with Brady now. We won the Super Bowl. But we wouldn't have won the Super Bowl if we left him on the field all the time. I'm put defense out and showing after the ball, right? And so for me, this is a period where I'm more interested in, we want to make money, of course, the market lets us, but I'm more interested in protecting capital, just making sure we don't take a hit. And there's a really important reason why, not just because I don't like to move money in mine or anybody else's, but if you didn't notice, once we come out of the box from the end of next year into the following year, it's the best 6 month script in the entire cycle. We get about a 50% balance of market from that low, right? So there's the, right now it's akin to picking up nickels in front of a bulldozer, right? And you try to squeeze a few more bucks out of the market. I mean, we're in, don't get me wrong, but now's not the time to get cute. What I want to do is protect that capital in outs, because I know that's on the horizon. Bigger opportunity in markets, right? So now, if the market gets a little bit away from us, there's that much help, but I don't mind so much. Because based on the mathematics, we can't take a hit. Right, it's math, right? This shocks a lot of people. You can take two portfolios that have the same average annual return, but with more volatility, you have a lower ending balance. Same exact return. Volatility can eat up your portfolio. I think about it this way: if you go 20%, you got $1 worth 80 cents. You actually have to go up what? 25% to beat, right? What if you went down 50%? They could go 100% to that beat. Downside is the killer to a portfolio. In the home run is not the answer. Success is in not losing money in drawdowns. So that's what my eye is on. Let's look at valuations. Right, I've added some other lines here to hopefully get away from the complete frowny face. Right, the frowny face is still up here. These are your Mag 7 stocks. Right, these are the small basket of stocks that have carried the market. They're very, very expensive. Right? But if you go down the capital table, if you look at small and big caps down here, actually be cheaper. On a historical basis, they're about average, right? So, in my mind, what we've been doing is trimming off where we can and not creating a huge tax bill. Some of these bigger positions, concentration in technology and large caps, and looking to those other opportunity spots. Financials, healthcare, utilities have been great this year. Other asset classes, gold were great for this year. The preferreds and more fantastic for us this year. There's a lot of other areas to be international. So, to me, I'm focused on the bottom line, because if you're looking only at the top line, get very busy scatter plot. All you need to know here is this is the expensiveness, the price earnings ratio, the PE ratio right here. The level we're at now, historically, has come with forward technical returns of 0 on average. Right? Until you all remember this, not too long ago. Remember what happened in 2010 at the stock market? Then the S&P ended where it started. They call it the lost decade. Right? I only bring this up is because we're just this U.S.-centric investor that could be a problem. But back then, even now, our portfolio were mostly international at the time, right? Next decade, we had none. We need to be open-minded to not just invest in U.S. companies, right? It's part of the strategy. So here, again, is the bottom numbers. So in the last 4 years, we really have like stretch and say like 6 black swan events almost, and from COVID to then supply chain problem, which calls the inflation cycle. The Fed, because they waited so long, and they marked up the fastest, increases ever, which was not great. Then you get the tariff tantrum. I mean, all these things, and through all this, the average stock, even though the market's at all-time highs, the average stock is actually a little bit cheaper. That's interesting to me. There's value there, right? All money's been focused in one spot, so that's good. Which obviously leads me to this. Value is underappreciated. Again, This is just a historically on a relative valuation basis. Value stocks are as cheap as they were that year, or the converse, the large caps are as expensive as they were right before the little meltdown we had in 2022. And so there's opportunity in other areas of the market besides Meta. Here's the point, right? We've got a expand horizons, which includes other asset classes, right? So this, I mentioned this, it's again, busy slide, but those boxes I showed you, what this is by decade, percentage of time, those boxes were called the best asset class, be it the one that we preferred. The 90s, remember that time? 76% USA rate. Go 90s, right up until it wasn't, right? Here's the 2000s I talked about. S&P went nowhere. Our process had us, the bulk of the time is international favorite spot, commodities. So we were playing in other ponds that were working, right? So to the last decade, this was just a no-brainer. You get quantitative easy time. With the extent that we had, money is just going to flow into the most liquid market in the world, largely cap U.S. stocks. And it wasn't just us; the entire globe was on a stimulus. And so here we are now. U.S. equity's still been dominating the first half of the decade, but I think it's subtly shifting. So don't be surprised if your portfolios start to head out more United stocks, gold, silver, things that are buying commodities, others. So be open to that. That's where we're headed. And we still have, though, a very pro-market, some people call it Trump, but president, for whatever it's worth. I mean, the most recent legislation that came out this bit very pro-growth for next year on the capital expenditure depreciation. We've got to get in the weeds there, but that should spur not spending for the economy. We're sliding into Alma gear. What's the Fed do? Yeah. So it was in Jackson Hole on Friday, his last speech. He's been put in the pickle, right? He's in a tough spot. Get pressure to lower rates. The data suggests he doesn't need to. If I were him, Larry and I talked about this on his podcast just a couple hours ago. I would draw on my shield. I know it's the right thing not to be practical, pushing rates down, and maybe he can preserve his legacy in that capacity. And even if he comes into quarter, I don't think it's going to be a big deal. But I don't think he wants to make a mistake. He's in the story, and he knows what will happen. So I think we probably did the September cut. It was 25. I'd be surprised if we got a lot near. We could. I would prefer we didn't. Because if we do, in the back of my mind, I'm thinking, what aren't they telling us? That's the other alternative. They're seeing something in the data. They just haven't told us out yet. I don't know. Maybe. But I think that's all right. Here's that money supply from Brad told you. Oh, we're going around nicely, and we understand, right? That was the inflation. All that pain we went through in the last couple of years only got us that far back. And we've already hooked up. So this is what I call the double-edged sword. All right? It's good for asset prices, right? More money, things usually go up, but it's also then potentially bad for inflation resurgence. So choose your poison there. All right, let's get down to this. All right, we covered what this was a couple of slides ago. Not much change, huh? What's happening in the top spot in natural commodities? So our risk on is still sound. A little bit of movement here. Probably that's because the dollar was weak. I'm not seeing much trouble on the intermediate to long-term basis, right? Seems sound still. So if you have been in my presentation before, you just probably a nice big sigh of relief. Almost the last fund. Percent for the last, even in good. Almost there. No. So, myself and my team take great pride and pains in what we do on a daily basis. And we give you a glimpse behind the curtain of some of these data points, and not to go, okay, kids, here to figure it out, right? Not the point. You guys have lives, there's other stuff to do. We bring it up to let you know that we're thinking ahead. There's not one thing that you hear from your Uber driver, this guy or that guy, Denigers. We haven't already factored into the equation, right? It's probably not in information, so you can trust that we're looking at it. I want you to leave with this picture. So this is the 100 years of the stock market. All right, it's not a week or a day or a couple of years, 4 years. What you see here is 5, possibly 6 distinct periods in our market history. The peach boxes were where we just kind of didn't make much headway. I grind sideways and consolidate. The green bars are when we kind of really took off in the market. The average of those, about 16 years. I started showing this slide in 2016 because when we did this research, we thought we were breaking out. If we rewind, the low in the market was 666. Broke out at 2000. Everybody can go look at the tape. That's it. Market's over. 300% move. Got. We were saying, I don't know. I think we just broke out. I think we're just getting started on the next big leg. And so far, that's worked out. That's been our underlying thesis. On all this time, obviously, we got to worry about the chop. You don't. We do. Right? That's your picture. One of the greatest wealth-building legs in the market. The question I've been getting recently is, okay, that's great. That was 9 years ago. We get long in the tooth. So I added one last slide, just for yes. Same data, but just revisualized a little bit. Let me add some dates to it. So if we pick a different breakout points, we've got 2 18-year bars. If we extrapolated this curve breakout to 18 years, let's just call 2031. Is that going to be the exact market peak? Absolutely not. I don't know if you don't. The point, though, is we may have another 4 or 5 years in this cycle, which is perfect for anyone that's real, right? So we get another maybe half a decade of this wealth-building opportunity. And again, it doesn't mean that this is going to happen exactly, or the market has to fall off a cliff, but the dips in the market should be perceived as buying opportunities, right? Things going on sale, as opposed to paying the word trouble, right? So I leave you essentially in the same spot as we were in February. I think we're in for some volatility, right? We've got a lot of seasonal stuff lining up. It's usually dicey in August through October. We saw the presidential stuff. Valuations a little high, but the underpinnings of the market, I think, are sound. So expect the volatility. We're looking at it. Your portfolios are already positioned for it. All right, there's cash levels. There's hedges in certain areas. We've already made some rotation to value. We're underweight big already capped areas. So we're gonna ride this out, and then we're gonna look for that good opportunity that comes at some point here in the next year on that big move. So again, I would be positive as I left the room. Good wealth building period. We just may have a little bit of indigestion here the last next couple of months.
2 last things real quickly. Eric comes up, he gives his time, he spends his own dime to come up here and talk to us. So on your way out, be sure you say thank you, ask him any questions you have, get to know him a little bit. And speaking of get to knowing, we did our first podcast with Eric this afternoon. So we were talking all kinds of smack about markets and money and how his kid's going to grow up to be a loan shark, either that or a rock star, and what have you. So I really got Eric to kind of open up and learn a lot more about him, how he thinks, how he looks at the markets and everything like this. So when Miss Mariana finishes editing that mashup of nonsense, she'll get it out. Do me a favor, right? Memphians are starving for more charts and graphs. We got to have more charts and graphs and smiley faces, right? So when you finish the podcast, send it to somebody, because listen, not everybody has access to somebody as talented as Eric to interpret all of this, right? Their advisor doesn't do that. Send this on to them and give them a real treat. More charts and graphs.
Bigger font on your axis.
And more font.
Bigger fonts on your axis.
Thank you, everybody. Eric, you're the best.